Sunday, May 17th, 2020, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at the Pennant in gold and how the technical picture for gold looks very good. I've been following this pennant or triangle, if you want to call it, for the last few weeks. I've waited until a confirmed breakout, and it looks like the breakout has been confirmed. Of course, nothing in markets is always guaranteed, but I'm going to reference Technical Analysis Explained by Martin Pring, where he talks about these consolidation patterns, because that's what a triangle or a pennant, that's what they are, consolidation patterns. I did a lot of studying on technical analysis when I was working in the markets. The firms I work for sent me to courses on technical analysis. And as you can see, I've got books on technical analysis. So I've done a lot of homework. I've put it into practice, advising my clients and even using it to trade. And what I can say about consolidation patterns like flags or triangles or pennants is that the probability that they will resume the trends is usually like 3 and 4, so it's not guaranteed. But once the formation breaks out, that means there's a very good chance that we're on our way to continue the trend. So let's get to the gold price and this pennant that we've been looking at. The best way to look at the pennant right now is on the daily chart. Weekly chart you can do it as well, but it's not as clear. So this is the pennant formation in gold. Why is it a consolidation formation? Well, because the trend before this pennant was formed was a rise in gold from the low in March around 1450. A pretty explosive rally, as you can see, from 1450 to 1750. So that was a $300 move in a very short period of time, probably about a month. Of course, it wasn't straight up. You did have some ups and downs along the way, but it was heavy volume, wide ranges. And then what happens in a consolidation period, it's like a breather. That's all it is. It's like a timeout. And in a flag, the consolidation is formed by two parallel lines. Independent, they're converging lines. So that's why it's also called a triangle. The range gets smaller, the volume decreases, activity calms down. That's why it's a rest. And as I said, there is a 3 in 4 chance that the breakout will be in the direction of the previous trend. So up in this particular case, we could have also a pennant or a flag on a trend that is down as well. In this case, it happens to be up. So how do you measure or project where the price of gold could go now after the breakout? Well, it's very easy. You just take the length of the first move higher, which is $300, and you extrapolate it or put it on top here from the breakout. And this is what you get. We get a move above $2,000 to above $2,000 to about $2,015 in the gold price. And what it's telling me is that it should happen very quickly by the 7th of June, as you can see here on this chart. Is it guaranteed that it will happen by the 7th of June? No. But generally speaking, I think this is where we're headed, towards the 2000 level. It could be less time, it could take less time, or it could drag on a little longer. It could be that we only go to 1950. It could be that we go to 2050. It's a little bit like nature and the seasons, for example. when spring starts in the northern hemisphere in April, yeah, you can get some beautiful days, warm days, and then you can get some very cold days, or you can get even snow in May, as we've seen in the US this year in New England. So that's the same thing with the markets. It's not a perfect science, but it's looking very good. So what does Pring say about these patterns? He says, flag formations are usually reliable patterns from a forecasting point of view, for not only is the direction of ultimate breakout indicated, but the ensuing move is also usually well worthwhile from a trading point of view. Of course, most of us here, the people who follow me, own gold as insurance, not as a trading instrument. I'm doing this, of course, because it will give you an idea of where gold should be going. And some of you might want to trade it. Am I going to be trading gold? No, even though I have traded in the past. But I think it also helps those people who use gold as an insurance, who accumulate precious metals as savings, knowing that the price could move higher here. If you've been on the sidelines waiting to acquire more physical gold, I would say that it would probably be a good time right now to get in there before it goes even higher. So in a sense, it also helps those who don't trade. Flags seem to form at the halfway point of a move. Once the breakout has taken place, a useful method for setting a price objective is to estimate the size of the price move in the period immediately before the flag formation began, and then project this move in the direction of the breakout. Since flags take a relatively short period to develop, they do not show up on weekly or monthly charts. So there you go, the weekly chart, it doesn't really show up. What does he say about pennants? Well, a pennant develops under exactly the same circumstances as a flag and has similar characteristics. The difference is that this type of consolidation formation is constructed from two convergent trend lines. In a sense, a flag corresponds to a rectangle and the pennant to a triangle, because a pennant is in effect a very small triangle. If anything, volume tends to contract even more during the formation of a pennant than during that of a flag. In every other way, however, pennants are identical to flags in terms of measuring implication, time taken to develop, and volume characteristics. So there you go. The other thing I would say, silver, of course, did very well towards the end of this previous week. I would look more at the gold-silver ratio to show us what's going on. And as you can see here in this daily chart, it looks like that ratio is collapsing. As you can see, this looks like a top in the gold-silver ratio. The key support now will be, I think, around 100. And then we could look for that ratio to get to 80 very quickly, I think. So that's looking good. That means that silver is going to continue to outperform. And before I finish, I like to say as well that in the stock market, for example, we have what's called the Dow Theory. One of the maxims of stock market investing is that you need to see a lot of sectors making new highs, confirming. So, for example, you need to see the transports, the Dow transports making new highs, the Dow Industrials, the S&P. It's always good to have confirmation. It's not good when the Dow Industrials makes a new high, but the transports fails to make a new high. That's not a very good sign. So I think we have kind of the same theory, I would say, in the gold market as it pertains to other currencies. And some of you might know that until recently, gold hadn't made an all-time high against only three major currencies. So that's the dollar, which we're still not there. We need to get to around 1920 to make a new all-time high. That was the high in 2011. But up until this last week, gold hadn't made an all-time high in Swiss francs and in the Chinese currency, or the yuan or RMB, whatever you want to call it. But this week it has. So the price of gold in Swiss francs is traded up above 1700. It closed at an all-time high of 1693. Same thing for XAU CNY, or the RMB. All-time high, it closed at 12,381. So the only currency now that needs to confirm is the dollar. All the other ones, of course, have made all-time highs and even made new all-time highs this past week. The pound is particularly interesting. Gold really exploded up at the late part of this week, and we closed at 1440. I think the previous high before this week was around 1406 or thereabouts. So it's really moved up. Why is the pound moving down so much against gold? Well, I think it's because we're hearing now from the Prime Minister, from the government, that they don't plan to have any austerity. They plan to spend and borrow as much as they can. So I don't think they're not even going to try to pretend that they're running a proper fiscal policy. And even though Andrew Bailey of the Bank of England says there's no fiscal dominance, I think he's going to play it right along and print as much as the Treasury needs. He's going to keep that Ways and Means account with unlimited funds for the government. So look out, British pound versus dollar versus gold. The way is lower. Why? Because that's the best way to inflate away the debt. They're forecasting 300 billion just in the budget deficit for this fiscal year. That will add on to the debt, and it's probably going to be a lot worse than 300 billion. These forecasts are always too conservative. So with that, I'm going to call it a day for this video. Of course, tonight at 9 p.m. London, I've got my live stream. So until then, have a great rest of the weekend. Take care. Bye.